This is an Uncovered Japan Company research report on cybersecurity cloud, ticker 4493. The company protects web applications through cloud-delivered security services. The question for investors is whether its attack data advantage, highly recurring revenue, and policy-backed market can support continued growth while the company proves its ambitious next phase. Cybersecurity Cloud's headline metrics frame the case. The report puts forward price to earnings at 21.7 times, recurring revenue at about 89%, annual recurring revenue at 5.2 billion yen in March 2026, and fiscal 2025 return on equity at 27.1%. These are the features of a focused subscription business, though they do not remove the risks of small cap liquidity and intense global competition. Start with the product. A web application firewall, or WAF, inspects traffic before it reaches a customer's website or application, blocking threats such as malicious logins, bots, and code injection attacks. CSC delivers that protection as a cloud subscription. Its WAF Charm service automatically tunes the native WAF tools offered by major cloud providers, which means customers can use cloud infrastructure without having to manage every security rule themselves. The revenue mix shows two established pillars. WAF Charm reached roughly 1.74 billion yen of annual recurring revenue, and Shidankun about 1.69 billion yen. Both are cloud WAF services, but WAF Charm's role in operating the native tools of AWS, Azure, and Google Cloud is especially strategic. Around them sit newer lines including Cloud Fastener, vulnerability management, and consent management, giving CSC more routes to expand customer relationships. The financial record is strong. Revenue rose from 1.8 billion yen in fiscal 2021 to 5.1 billion yen in fiscal 2025, a compound annual rate of about 29%. Operating profit grew even faster, at roughly 39% annually. In a subscription business with a largely fixed engineering and research base, that difference is operating leverage. Each incremental yen of recurring revenue can carry a higher contribution to profit. The earnings chart makes that leverage visible. Fiscal 2025 operating profit reached 1.10 billion yen, and net income 822 million yen, with operating margin reaching 21.7%. The report attributes this to the scaling of recurring services, particularly WAF Charm and Cloud Fastener. Investors should still watch whether the margin can hold as cloud costs, competition, and product investment evolve. Cash flow broadly supports the profit story. Operating cash flow reached 1 billion yen in fiscal 2025, while free cash flow was 578 million yen. The report notes that free cash flow reflected the DataSign acquisition, which also broadened CSC into consent management. A cash-generative, effectively net cash balance sheet gives management room to invest, acquire, or return capital. But the quality of those choices remains important. CSC's moat argument begins with real attack traffic. Shidankun's installed base has collected data on attacks for more than a decade. That data helps improve detection. Better detection helps retain and win customers, and a larger base produces more data. WAF Charm turns that advantage into automated rule tuning. Reported churn is around 1% or below on the two WAF pillars, suggesting that once protection is embedded in a live application, customers are reluctant to switch it off. Management's next plan targets 20 billion yen of revenue and 4 billion yen of operating profit by fiscal 2030. From fiscal 2025 revenue of about 5 billion yen, that implies a 31.5% annual growth rate. The report is constructive but clear-eyed. The organic base alone does not get all the way there, so the target depends on M&A as well as re-acceleration in the core business. On valuation, CSC is not a one-line answer. The report puts forward price to earnings at 21.7 times, roughly in line with its TSE growth information and communications sector comparison, while fiscal 2025 revenue growth was 31.8%. On price to book, at 4.1 times, the shares look richer. The high return on equity supports some premium, but the valuation depends on continued growth and the market's confidence in its durability. The scenario range is a framework, not a prediction. The report's 3-year bear case is about 20% below the reference price, the base case about 58% above it, and the bull case about 179% above it. The spread reflects the variables that matter most: competition, cloud cost inflation, price revisions, annual recurring revenue, and execution against the growth plan. Following those operating indicators is more useful than treating a scenario chart as a target. To sum up, Cybersecurity Cloud is a focused Japanese Cloud-WAF specialist with a meaningful attack data flywheel, 2 sticky subscription pillars, and clear operating leverage. The opportunity is supported by cybersecurity demand and a high recurring revenue base. The risks are equally clear. A small company competing against global platforms, pricing power still being tested, and a fiscal 2030 target that requires exceptional execution. This is research, not investment advice. Use the full 5-part deep dive for the evidence behind each point. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.